Welcome back to the Money and Wealth Show. I'm Sterling Fox. Our special guest this week is Jillian MacPherson from TD Waterhouse in Vancouver. Jillian is a portfolio manager and here to help us through the very latest survey results from the folks at TD Waterhouse on the investing habits and priorities of Canadian women. They've just released the 10th annual Female Investor Survey. We talked about, in our first segment, Jillian, about the fact that you've identified women as being far more conservative investors than men, generally speaking, and I couldn't begin to take issue with that one. I think you're bang on. If that's the case, what sort of investment vehicles do women tend to prefer?
I think women prefer more guaranteed products like a GIC, fixed income bonds, mutual funds. But it's interesting, once I developed that relationship with clients and with females specifically, and there's a bit of an education process that comes along with that, they get much more comfortable and I say, you know, why don't we own TransCanada Pipe? It's going to pay us a nice dividend, you can do a dividend reinvestment plan, and you understand what you're doing, and we're in control. There's visibility in your account. You have control about what is going on in your account. So my preference, quite frankly, with what I do for most of my clients is to own actual individual equities.
Interesting. Now, you've identified GICs a couple of times, probably the ultimate conservative Canadian investment possibility, right? But really, with so many other options available, do women sort of go to GICs because they see that as a solid, safe, conservative, secure investment, if any investment can be tagged as being secure?
I think they do, but along with that education process that you and I have just discussed is the process where we walk the client through, this is how much you need to retire. That is going to drive basically a presumed rate of return that we are going to aim for and which will be our goal. You can't attain that goal in most circumstances with a GIC-like rate of return given where rates are in this day right now.
Right. So I suppose you could buy GICs all you wanted, but if you want to realize some real return, you've got to be prepared. And I guess anything other than a GIC represents risk, doesn't it?
Yes, for women it does represent risk, but risk is also too retiring with not enough money.
True.
And when you look at the compounding effect of savings, for example, if you save $3,000 over 40 years at a certain percent of rate of interest, let's say 6%, 6.5%, you would actually have to save about $3,800 a year, 28% more at 5.5%. So that 28% more you would have to save if you took less risk. So when you turn it around and say, where's that money going to come from? There's your answer.
Right. Women, I would gather, though, it's not a question of being convinced, but there has to be a pretty persuasive argument for a typical woman investor to move towards individual stocks or equities rather than the tried and true?
Yes and no. I mean, there's certainly some female clients that come to me that were former GIC, I like to call them refugees, and are looking for yield. And I think that's much more common these days. Retirees and other clients that are looking for income have to get out of that GIC home. Once they're out of there, yes, you're going to be taking more risk, to your point, but it's commensurate.
I wanted to talk about bonds a little bit with you, Jillian, because bonds traditionally are the next step away from the ultra-conservative GIC. Again, long-term perception is safe, perhaps not the biggest money makers on the block, but a great place to park your dough and watch it grow slowly. And yet now we're seeing, particularly with the U.S. Treasury and all of this printing money, which is called quantitative easing, euphemistically, they're printing money. And they're buying U.S. bonds with their own money, which essentially is digging the debt hole deeper. What's that done to the attractive quotient of U.S. bonds?
Well, I think it's quite interesting. I mean, we've seen Procter & Gamble bonds trade through treasuries, meaning people would rather own a Procter & Gamble bond because they understand what Procter & Gamble does.
Sure, they make toothpaste or whatever.
Than U.S. treasuries. So what's happening is people are starting for the first time ever to question the validity of the paper it's printed on from the U.S. government. Right. Not so much from the Canadian government, but more so the U.S. government. So I think the corporate bonds have gained, the spread has narrowed between government treasuries and U.S. corporate bonds.
Are your clients, generally speaking, again, more interested in a government bond? Is it a big job for you to persuade a client to look at a private issue from a corporation, maybe BC Hydro or whatever, versus, say, the BC government? In terms of those are options A and B on the table, how do you get that person to look at the private sector over the public sector?
Well, it's interesting. I deal with a lot of clients, and we have what's called an investment policy statement. The investment policy statement will say X% of your assets needs to be in provincial or federal bonds. So we have to do that. And certainly at TD Waterhouse, we would advocate basically a very conservative approach. You do need some of your bonds in provincial and federal bonds. However, that being said, some of your other money, it's not too big of a convincing because you need the yield. You have to go look at the corporate bond market.
Okay, what's the recommended TD Waterhouse balance these days in terms of inside the portfolio? 50% bonds, 50% stocks. What's the current ratio?
Well, it's actually quite interesting. Our investment strategist at TD is actually advocating right now 65% equities, 35% fixed income.
Interesting.
He feels that bonds are expensive here, which I have to agree with. And he also feels that there's a tremendous amount of opportunity in the U.S. equity market.
Okay. Now, all of that is said against a backdrop of something terribly fresh in all our memories. Just a couple of years ago, a lot of people took a big hit with their holdings when we had this spectacular crash. Economic times since then have been dodgy on a good day, and yet there is this statement from TD that perhaps we should pay a little more attention to equities than we have in the past. What's the reasoning behind that?
I think it's fundamentally because rates are at their historic low. Therefore, bonds are expensive vis-a-vis the alternative, meaning equities.
Okay.
So the spread between where we would normally see the S&P 500 trade over a 10-year treasury is about 400 basis points right now, 450 basis points. In the norm, equities would be a buy at anywhere above 200 basis points. So you would tend to favor equities if you just look at that spread. However, I have to say that it's always on an individual case-by-case basis. You have to look at their risk tolerance
sure.
and where they are. For example, if a client has $10 million, why do they need to take any more risk on at all?
Right.
Right? It's about preserving capital at that point.
Right, right. And these times, literally, there have been days when it's far more important to preserve the capital than to try and make any money, because that's the ebb and flow these days, isn't it?
Absolutely. I mean, you're going to be clipping your coupons on your bonds right now, but your money's safe.
Interesting stuff. Our guest this week is Jillian MacPherson, Portfolio Manager with TD Waterhouse in Vancouver. Lots more to come here on the Money and Wealth Show. Stay with us.
Hi, I'm Larry Ray, President and CEO of Gold Ray Resources Corp. Our major project is in Shandong Province, China. It's a gold project with a 43101 resource. We're currently negotiating a $16.5 million US loan to take it into production at 1,500 tons per day. For more information, go to goldray.com or phone me directly at 604-531-9639.